This is the Power Producers Podcast, where we are refining and redefining the sales game.
Rule number one is you have to believe in yourself. You're the only one who doesn't think you belong in this appointment. The prospect has already validated your existence by scheduling time with you. Get it through your head you belong here, go in there, crush it, and close the deal.
A place where sales professionals can come to learn from other sales professionals and thought leaders that have mastered their craft.
The difference between a good salesperson and a best-in-class salesperson is only 2 minutes. By spending an extra 2 minutes on what you might think is a mundane task in the sales game, you separate yourselves from the pack, you grow your book of business, you close more deals, and you retain your accounts.
As well as their peers who are still striving for perfection to achieve their why.
I have a wife and 4 kids. Failure is not an option.
Real sales professionals, real stories, real results. Are you ready to feel the power?
What's up, everybody? Welcome to the Power Producers Podcast, where we are refining and redefining the sales game. And one of the ways we do that is bring to you experts in our industry that are doing things that you may not do now or might need to consider as you continue to progress in your career. And certainly the topic of captives has come up more and more over the course of the last 6 months. And I personally don't think that it's going to go anywhere anytime soon. I think that the purpose has changed a little bit in terms of where people might have been looking to use captives in the past versus where they're using them now. But we're going to get through all of that stuff when we talk with our guest today, Mr. Jarid Beck from Risk Management Advisors. They have offices in Irvine and all over the U.S. They can service any state. So you 30,000 plus that download this podcast every month have a resource for questions about captives and a resource to help you help your clients if that's the direction they want to go. So without any further introduction, we want to welcome Mr. Jarid Beck. What's going on, Jarid?
David, I'm doing fantastic. Excited to be here. How are you doing?
I'm good, man. I'm good. I mean, I live in Tampa, Florida, so there's that. We're dealing with everything that goes along with Florida in the insurance marketplace. But funny enough, I don't think that it's really any different here than it ever has been, to be honest with you. I mean, I've been in the industry for 20 years and it's been a hard market almost the entire time. Certainly some of that's tongue in cheek, but the reality of the matter is if you're going to do what I do in Florida, you better be wearing some Kevlar britches to do it.
That's right. Florida's always been an interesting place to conduct business, specifically insurance business or be an insurance buyer. So, yeah, your experience, you're not alone in that experience. So we have some clients there that would agree with you.
Yeah. So talk to me quick, let's get through your background. And then I do want to spend the bulk of the time talking about captives as a solution and how agents can introduce that conversation to their prospects and clients and why that may make sense and some things they should look for, maybe even in their existing book to trigger them to think, you know what, this is getting big enough now. It's probably time for us to have that conversation, because the people who listen to this podcast, by and large, are working in that middle market arena, but that means so many different things to so many different people. Some people think middle market accounts are $25,000 in premium, all the way up to $1 million plus in premium. So it runs the gamut, man. So before we get into all of that part of it, sort of talk about your background and how you got into the captive space that you're in today.
Yeah, you bet. So I started about 20 years ago myself at Northwestern Mutual. So it was life insurance, financial planning, tuck a buck a day away, strategies, and pretty quickly realized I wanted to deal on the business side of things. Right around that time, the first .com crash happened. So I put money into college funds for folks and it tanks 40%. And, I'm getting these calls and, I quickly realized that side of the table wasn't for me and wanted to get into, business planning. So I went to a firm out here in our area that specialized in those, financial planning strategies for business owners. Started doing, defined benefit plans, retirement plans, non-qualified deferred comp, business owner type strategies. And it was there that we stumbled across captive insurance companies. Me and my partner, Wes. And, at first we liked, the asset building aspect of it. But then as we looked at it, we're like, man, what a great creative, different way for people to address their insurance problems. So we just saw it as this multifaceted tool that could, check a lot of different boxes for business owners and their companies, and decided to go, full freight into that space. So that was 2004. And we co-founded Risk Management Advisors. And then, fast forward to today, we're, depending on whose list you look at, top 6, top 10 in the space for captive insurance companies. Back then it was, a lot of builders and developers. It was the housing boom. Insurance market was very difficult, from a general liability standpoint. But then over time, it's really just diversified and ballooned into, really most any industry where the companies are high performing, and then looking to get, again, creative and aggressive, with their risk management strategy, save some money on premiums, and build an insurance company asset.
So you're in the captive space now. I think that the first question a lot of people have when I'm talking to them about captives in conversation is, hey, do you know anywhere we can put our real estate investors and all their property schedules and everything? Because that area is getting crushed, as are the majority of the captives that I'm aware of in that space as well. But talk a little bit about the types of coverage that you typically see people put into captives, and specifically what it is that you guys specialize in.
Yeah, you bet. So our primary specialty is single parent captives, or pure captives, which is a captive that is really set up to serve, to write the insurance or serve the interests of, one company or their family of companies. And that would be in comparison to like a group captive, where maybe you've got 10 or more business owners or insurance buyers coming together to form a group captive, to help create capacity, at a group level. Both are really good, and we can talk about, who goes where. But for our part, I'd say 90% of our business is helping individual business owners kind of restructure their stuff and setting up stuff for them individually. As far as lines of coverage, depending on the industry, it could really be any. Very common is workers' comp. Companies that have high payroll, if they're paying $1 million or more in, traditional first dollar premium, can be a good candidate for a workers' comp captive. Obviously, if they've got their safety, you want to have your safety programs in place, doing a good job on the risk management side. But, workers' comp is a good baseline bedrock line of coverage for any captive program. Now we're dealing with hard market. This, so we've seen huge uptick in the number of general liability captive programs that we're putting together. Auto, property to some limited degree. We can, get into the differences there. And then, believe it or not, there's actually awesome stuff you can do with excess lines of coverage now that, you could never do before, when I first got into the business. Some really exciting structures and programs around excess lines of coverage, because even that's expensive now, right? I'm sure you're seeing that with some of your people. The primary gets more expensive, but the excess has also gotten to some pretty nosebleed levels in premium. So there's some good stuff there.
I literally just had one come in where the excess, and it's not the primary is written on a 2-4, $2 million per occurrence, $4 million in the aggregate. And the primary was 2 excess, the 2-4, and it was double the primary. The excess premium was double the primary premium. And it was an interesting class of business, higher hazard, but essentially it was a very specialized medical staffing company, right? Mm-hmm. So there are things that could happen there. And it wasn't an account that would be big enough yet to consider moving into a captive or whatever. There's still guaranteed cost, but we're at a point where we're having to look at, okay, let's see what kind of risk you can really take from an active retention strategy standpoint, so that you're on the hook for the first 25 or 50 grand knowing that you better have your policies and procedures in place. But we're at a point now where risk sharing is going to happen for people to be insured at an affordable level. I feel anyhow, because if you want first dollar coverage across the board, you're going to pay through the nose to get it, depending on class of business. So I say that because, talk for just a second, if you don't mind. What's the normal progression for somebody? Because I've always sort of advised people who get aggressive, right? They'll go to a trade show and they'll hear somebody talk about captive insurance, and they come back and all they want to hear is, oh, what are you going to do to get me into a captive? Meanwhile, they're paying like 350,000 in premium. They didn't even have a return to work program until last year. We could go right down the line of all the reasons they don't belong in it. So the first thing that we usually advise is, regardless of line of coverage, why would you want to go look at a captive when you don't even know that you can control what you've got when it's first dollar? Take a little bit bigger deductible or retention than what you're currently taking, so you can see how much you really enjoy being on the hook for some of that risk. Then you can go from there in stair step upward, ultimately ending in a captive. Plus, depending on what state you're in, there's rules and regs about how big your program could even be before you can go down that road, or at least there is here for high deductible stuff as well. You can't even get a typical high deductible program unless your premium's at a certain size in the state of Florida. So for the companies that are growing and they think that's where they want to end up, what's the normal progression look like?
Yeah, it's a great question. So you have to set yourself up for success. So, we get those same calls. People are, hey, my insurance premium is really expensive. I need a captive. And, maybe they're paying, let's go back to $1 million for the workers' comp. That's outrageous. But then it's, well, what are your losses? Oh, they're $1.3 million. And it's like, well, it's actually not expensive. You're actually getting a great deal. And, to your point, if you go set up a captive just to pay $1 in, only to pay $1.30 out, then, your captive's going to be upside down and bankrupt before you know it. So, you really have to have the confidence that, your losses are going to perform better than, better than average, and certainly, good enough to run a profit. So that's piece number one. The other thing is, captive doesn't necessarily just mean cheaper insurance, right? So when you're getting into the captive space, you're setting up an insurance company, and, depending on what type of program you set up, that's going to require a little seed money, a little, capitalization. And then there's setup costs for the captive. So it's really not necessarily even, less expensive in the first year sometimes, but it's more of a long-term play where you're recouping underwriting profit over time and reducing your overall cost of risk. So, again, same thing. We get the calls at, 2 weeks before the renewal, and, they're dealing with a tough renewal, and they think, captive is going to be the, the silver bullet to solve that, to solve that problem. And it's just, it's not enough time, and it's not the right mentality, to approach the captive. It's really, again, more of a long-term strategy, to reduce the overall cost of risk, put the underwriting profit back in your pocket in a really tax efficient way. And so again, that takes a, long-term, mentality there. And then, so if you feel like you've got those things, then the next thing to do is to, go to your broker or go to your advisors and, sit down and have a conversation about, I'm interested in a captive, and first define, what does captive mean to you? What are the reasons for, for pursuing it? And then, go through, what we call either a preliminary feasibility study or feasibility study phase, where you're looking at the data, you're looking at the policies, company factors, exposure, et cetera, and then determining what would work, what wouldn't work. I just got off a call before. There were a couple of things that would work really great in a captive for this particular, insurance buyer. But it wasn't the one thing they wanted to address. So, I thought it looked great, but for their perspective, it was like, well, we can't address this one thing. So, it didn't make quite as much sense. So it's got to come down to, hey, can we address your specific needs, with the captive? And then, through that analysis, you say, all right, well, if it makes sense, go, no go. Do we want to set it up? And, then if you do, then, we would handle, setting it up and managing it, and then, helping the client get the benefits for it. But it's kind of having your internal house in order from a, risk management perspective, and then building the, insurance company to benefit.
So you mentioned it sort of just quickly in passing, but I want to go back and have you talk a little bit about the tax benefits of a captive. I know that it's changed a little bit over recent years, but there were a lot of companies that I've run into in my career that I've called on, where I find out they actually have an insurance program, but then they also have a captive in addition to that, because it was a mechanism for them to be able to put away money for tax benefit. Is that still similar to the way that it was, or how has that changed, and what are the benefits to a company to go down the captive road from a tax standpoint today? Understanding, well, you may very well be a CPA. I don't know that for a fact. I'm not, so I'm not giving any kind of tax advice, and I don't want anybody to misconstrue what we talk about as any kind of advice. So there's the risk management disclaimer on what's getting ready to happen.
That's right. Yeah, no, I'm not a CPA or a tax attorney. So yes, this, disclosures aside, does not constitute tax advice. That being said, we can discuss it at a high level. And insurance companies and captives do get favorable tax treatment compared to other companies. So, and it's very rare that when you set up a captive that you completely exit the traditional market. Take workers' comp, for example. So, you could say, hey, I want to take risk on my workers' comp, but you don't want to take all the risk. So you're always buying some level of high deductible or reinsurance to protect yourself from catastrophic losses. And then also you need, you need the state by state admitted carrier, to properly, issue the workers' comp policies. So you can't just say, hey, I'm going to set up a captive and then, self-insure all of my workers' comp. You still have to partner with a carrier that can help you protect the catastrophic and then get you into the states. So a very common structure would be, take a high deductible policy, let's say you go from $0 to $500,000 in retention, but then instead of just self-insuring it, you would set up the captive, and the captive would take the $500,000 retention. The benefit of that being, if it's properly structured, the insured is going to pay the premium over and then take an expense or take a deduction just like they do for regular insurance. So getting the tax deduction on the front end. And then when the money comes into the insurance company, we're like your company, my company, we take in $1, we pay staff, and then whatever's left over, we pay taxes on. Insurance companies work different. They take in $1, they pay the expenses, but then they can take whatever's left over and put it into reserves to pay future claims. So you get to accelerate the deduction for future losses. And then you get to earn investment income and grow the asset base with, the pre-tax value as opposed to the after-tax. I'm sure you've read or heard about, Warren Buffett's Berkshire Hathaway reports. He talks extensively about that, right? About the ability to use float, to invest, because he's got money sitting in reserves to pay potential claims, whereas other companies, just regular companies don't have that advantage. So that's the general tax benefit there. Frank, captives, it used to be a thing that only Fortune 500 companies, publicly traded companies would do. It's trickled down to the middle markets, but that preferable tax treatment has always been a motivating factor. The key thing with getting into a captive, and I'm sure you observe some of this, is it can't be the only reason or the primary reason. At the end of the day, insurance companies are, risk management tools first and foremost, and you need to use them that way. There was a lot of people that would just set them up. They weren't too interested in the insurance. Some of the risks were, relatively esoteric, and they were just looking to put away large premium dollars and take a deduction. And that's the type of strategy you probably need to stay away from.
So that's good segue. I think that you've probably seen, I suspect you've probably seen captives that have worked really well and captives that haven't worked so well. What are the common mistakes that you see that cause captives not to work the way that they should?
Yeah. So the mistakes people make, one thing is taking on too much too fast. So, middle market companies, they can develop relatively quickly these days, right? People people know how to scale businesses, and you can very quickly go from, working with your local, the guy you met at your first networking meeting or whatever, the local guy, to, all of a sudden having, much more sophisticated insurance needs that, and maybe you've outgrown that, that person, right? And then, so now you've got all these things that you can potentially execute on in a captive. And the key thing is not to take on too much too quick, because you've got a growing business. And then, if you say, hey, I'm going to set up a captive, and you can do workers' comp, group medical, excess lines, cyber, sometimes it can be overwhelming. And then, you get it all set up, and then, it's, you don't fully grasp what's going on, or too much too fast, and then frustration can ensue. Maybe it puts too much burden on the team. So we like to take things in a phased approach. It's like, all right, let's deal with the primary objective first, and then, hey, here's a phase 2 and a phase 3 strategy that we can look forward to implementing down the road. But let's bite it off in chunks and not distract from running your day-to-day business. So that's the key thing. Other issues that can be undercapitalizing. So we've seen some captives where they're writing earthquake insurance, and they've gone in with the regulatory minimum amount of dollars, regulatory minimum capital. And it's like, all right, first earthquake, this captive is going to be upside down. You haven't adequately capitalized. So there's, getting in for the right amount of capital versus, the regulatory minimum. And that comes back to good, feasibility study work on the front end, to make sure you've got the right amount of money in there to support the program. So.
Well, it's no different than people who buy state minimums on auto because they think they're saving money when really they're putting themselves at much greater risk by doing that. Underfunding a captive, even though the mechanics of it aren't the same, it's the same general concept. And I wonder, I would think the collateral, or not necessarily just the collateral, but what you have to seed a captive, the money to fund it on the front end, that's probably one thing that would drive a lot of businesses to try and maybe make it like an industry group captive or something along those lines, where multiple companies can help to seed it, as opposed to one having to come up with all the finances to do that. You had said earlier, you think individual companies, dealing with individual business owners or decision makers at companies is the best way to do that, or it's the most popular way. I got to imagine that there's a lot more to deal with when you're bringing multiple entities in and having them own a captive together, especially when money's involved. And then I'm sure, you're going to have that one company that has the shock loss that blows it up. And, what's that dynamic look like? If you're going to start a captive, because I know how the people who listen to us think. Half of them are thinking about, oh, I've got a client that would be perfect for this. Another half of them are thinking, oh man, I could get all the roofers in Missouri to join a captive if I just put one together. And I shouldn't say half, but 33 and a third. The other 33 and a third probably turned it off 10 minutes ago, because we're already talking way above their head. They have no idea, that this is something valuable that might help them down the road. So, what are the challenges of having multiple entities versus just having it belong to a single business?
Yeah, so there's definitely situations where a group captive is going to work better. So if you've got those insurance buyers that are in that, let's say GL, comp, and auto together, and they're in that 300,000 to maybe, $1 million collectively between those three lines of coverage, group captive could be a really, really great alternative, because, at those premium levels, as you were alluding to earlier, maybe it doesn't justify setting up a individual captive, to take on that much risk and cover those 3 lines of coverage, not quite feasible. But a group captive we could join in would be, much less, collateral or capitalization to get in, and then be able to get some premium stability or savings and some underwriting profit out of the group. And that's kind of the size insurance buyer that the group captives are indicated for. Things to be aware of is the loss ratios and the performance on these things, David, has actually gotten a lot better over the years. There used to be problems where like bad insurance buyers, the good ended up subsidizing the bad, right? There would be a bunch of bad actors in there having bad claims, and then the good guys, all their money went to cover their losses, and then everybody's, collateral went up or the captive would shut down. That used to be a big problem, back when I first got into the business.
Well, you also just described a poorly run PEO, because that's the same thing, right?
Yeah, for sure.
You get a PEO that's got $1 million deductible per occurrence with no annual aggregates. Essentially, they're self-insured, but then you have the gunslingers out there selling deals left and right to high mod business. And meanwhile, they come in, they blow up all of the claims inside the deductible layer. Meanwhile, all of this beautiful white collar business that's a lower rate sitting over here and doing their best to subsidize. And the next thing you know, you've got a horrible loss ratio. You're going to have to pony up a lot more collateral at renewal. It's one thing after the other that gets affected. It's massive chain reaction. Yeah,
exactly. And that phenomenon, can still, but used to happen all the time in the group captives. And, now what I tell brokers is, definitely, look at the group captives that are out there, see if they make sense for your client that fit in that range that I described, but be ready for a very thorough underwriting process, because these captives, they want to admit best in class, guys that are doing it better than their competitors and stand to contribute to the pool positively, so that everybody can get the benefits that they're looking for. And there's a lot of good ones out there, and I think people should have that in their in their repertoire. And so that can definitely make sense if you're trying to start one from scratch. And I think you're right, David. You probably got a segment of your audience is like, okay, here we go. I got these guys. We're gonna get this set up. It is key. So when I talk to the underwriters, usually want to have $2 million ish of collective premium to get that carrier partner interested in partnering with you or having that discussion about setting up a captive program, either for your group or your agency. And everybody's mileage will vary depending on industry, et cetera, but that's a good rule of thumb. And the key thing is that you do have control over the book, because at the end of the day, you do need enough people swimming in the same direction and being willing to enter in and execute, at some common renewal date to get the thing off the ground. And that's where I see most of the programs fail, is because, 2 folks will be fired up on it, and then 3 are a maybe, and then 2 are a no, and then, someone backs out, and then you don't have that critical mass anymore. So, kind of getting that collective consensus is a key deal if you're gonna fire one up from scratch.
So speaking of firing one up from scratch, what's the time frame? Like what's a realistic time frame? If I say, you know what, captive's a strategy for me, I think that it makes sense for me to get my client to go down this road. I'm going to start today. How much runway do I have to have? You said tongue in cheek a couple of weeks before renewal, people, think, oh, captive may be an option. You and I both know that's not tongue in cheek. That crap happens in real life every day.
Oh yeah.
You can't put something, understanding even the experts who are doing this, captives can be complex, but complex to explain to the end user of it, the person who actually owns it. I have to believe there needs to be enough time for you to have a runway just for the educational piece, let alone everything else. But you got to have a lot of information. And that's probably another follow-up to this. Number one, lead time. And number two, like what are the basics as far as the information you need to even begin to do a feasibility study? Because I know that agents are going to say they have a hard enough time getting loss runs for a regular renewal? How do you expect me to get audited financials and all of this other stuff that you would need to put do a feasibility study on a captive? So I'd be interested in just the basics that you would need so that they can know if it even makes sense to push to go further.
Yeah, the nice thing is there's so many domiciles now that want captive business. And then there's, and captive managers, have gotten better, or most, or at, knowing how to structure submissions so that they'll get speedy approval. And by speedy, I mean, once you say go, and I want to set up the captive, that could be, let's call it 5 to 8 weeks, which is pretty good. It's much faster than it used to be. In some circumstances, depending on how much tailwinds you get, could be faster. So the actual setup is not an overly long process. That education component, right? The planning, what do we want to accomplish? What are our goals and objectives? And then, seeing if that can work. That's the piece that does take the time, depending on what you want to do. And so what we've started doing, it used to be you had to do what's called a feasibility study, and you would collect a ton of data, and the client would end up, pinning one or multiple checks to the actuary, the attorneys, consultants, et cetera, to get, this full-blown analysis, which was both timely and then, tough from a data collection standpoint. And what we've started doing is really more of a preliminary feasibility study. So if we're working with a broker and it's his client, with the basic information that they would have in a file, we can sit down and say, hey, I don't have exact numbers for you, or, we can't pencil this out to a T, but here's what this would look like. Here's what we've seen in other cases. Here's what we know carriers are willing to participate in. Here's what, our actuaries say. We have internal rating models where you can rate out certain lines of coverage, cyber, so on and so forth. And you can get back with a very reasonable indication or sketch of, what a program might look like, and then see if there's traction there with the client. And then if there is, then you can dig in on the much, more in-depth underwriting or info request. And then, as far as audited financial statements, things like that, you don't even have to get there until you go into, maybe underwriting with a reinsurer or the formation stage. So that's been one of the nice, developments over the years is, just, hey, how can we get, what is feasible, what is execute, what somebody can execute on back to them quicker, to keep the momentum going. But again, it can vary, it just varies based on what you want to do, right? So if you're talking about wanting to, general liability, workers' comp, or you need to partner with a carrier, you need to go out and quote reinsurance, then, you want to be starting 120 days, just for the underwriting portion. So then your education is probably coming, a month before that. So, you want that, 6 to 7 month runway on something like that. If it's somebody's coming in for a very specific thing, I talked about that excess lines, captive strategy, that can be turned around a lot quicker because it's very specific. You jump right into it, and, you can get that done in a tighter window. So it just depends on what you're wanting to accomplish. But yeah, you definitely want to factor in education phase, structuring phase, and then implementation.
So what does it look like on your side? Do you guys have to go through every year? And, I'm sure you're working deals with reinsurers left and right, but is it a deal by deal basis? Do they give you a certain amount of capacity you have the ability to operate up to? Or, is it every year you're having to start over from scratch, figuring out who's going to be the players, who's not going to be the players? Because I could think that could get really, really time consuming at some point as well.
We always try to keep a pulse on who the carriers are, just like any, if you're specializing in a space, you got to know who the carriers are that are interested in playing ball, with you. So that's, kind of on the awareness, for new captive prospects coming in. Once you get somebody set up, it's really ideal to set up a long-term, partnership. especially on the comp and the GL, where there's a high level of claims handling, risk management. If you can settle in with a nice carrier partner for a period of years, then, the whole point of captive is to optimize, premium spend, but it's also to, you develop partnerships. Everybody's interests are aligned, right? Everybody wants the losses low, the underwriting profits high, and it becomes less about, price and more about quality. That's what we strive for with a lot of our clients. On the front end, keeping track of, whose appetites are what. That's always it's always a moving target. And, with the capacity issues these days, there seems to be less and less targets, but we still get it done.
One more question, I think, then I think we will have beat this horse to death for the average agent on the street. But, I think that a lot of times when people hear captive, they think blank slate, and you have to create everything from absolute scratch. So what about the coverage forms, man? How do you decide what coverages you're going to offer, what sublimits, what extensions, and all of that stuff? I mean, are you trying to mirror what a traditional program would look like to the best of your ability? Is it more of an a la carte thing where every time you have an engagement, you're sort of customizing it to that unique company's needs, which also makes sense? I know what the average insurance policy looks like in terms of number of pages. And I know, that we're bound to stay inside the guidelines of what the state approves in terms of ISO forms and all of that. So what rules do you have to adhere to? And what's it like actually having to put a policy form together to provide the coverage?
So sometimes we get to piggyback off the carrier's policy, right? So if, we've got, so in some arrangements, the captive will actually reinsure what's called a fronting carrier, which is like just a traditional carrier issuing the policy. And then so we're using their policy forms. And the captive's just acting as a reinsurer. That's the way the group captives work. Carriers issuing the policy, the group captive is just paying losses. So in that setting, you're using the carrier forms. If it's an instance where, clients are going to do their own coverage, what we've seen a lot is cyber. The cyber market is limited, it's expensive. So, a lot of our clients are like, hey, why don't I just do this myself? And there they leverage one of the big benefits of captives, which is you can manuscript your own forms. And by manuscripting, it's not them manuscripting, but it's them telling us what they want. And then we go out and manuscript it, make sure it covers all the stuff that they want to cover. So ironically, a lot of captive policies are not as long as traditional policies because we're not as busy excluding everything.
Right.
We're coming back in and we're saying, hey, we want to offer more broad coverage. We want to protect the insured on a more broad basis, for the same or less premium. And so, you don't need all the pages of exclusions. You just need to define what it is you want to cover, and then a more limited set of, sort of standard exclusions. So, we have a team that handles that. We have a claims and policy management team that works on those. And then obviously, insurance counsel that reviews and helps us craft that stuff. But that's part of what we do as the captive manager is to, policy forms, claim software, claim systems, claims handlers, accounting, bookkeeping, all the financial record keeping, the regulatory interface. It's handling all those aspects of an insurance company so that the client gets the benefit, without it distracting too much from what they do best.
And you said it really quick. I want to just make sure we clear this up too. As far as claims handling goes, how does all that work, right? I mean, is the captive the one who picks their own TPA? Does the reinsurer have any say? Is it the reinsurer's TP, claims handling that we use? What does that look like?
Yeah, that depends. So if you're using a fronting carrier or, high deductible partner, then, you're probably limited to their list of approved third-party administrators. If it's a coverage that you're writing direct, there is no fronting carrier. It's just you're writing it out of your captive. Again, come back to the cyber, then we have a claims handling team here that can help people, adjudicate their claims that would come down the road. And then, we've got other settings. You mentioned PEO. So we have a large PEO. They're actually self-insured for workers' comp in the state they're in. They use the captive to hold all the premiums and the reserves, and they pick their own TPA. So, and they have that flexibility. So again, depends on the engagement, the line of coverage, but so either you're using the carrier required TPA, leveraging our in-house services, or if you're fortunate enough, you can select your own.
What have we missed, man? We've been going for 45 minutes almost. Is there anything that I haven't asked you that you would want to get out to let people know about captives, or at least increase awareness about it? And one thing I do want to make sure that we talk about is, how do they find you, get a hold of you? Go ahead and lay it out there while we're going down this road.
Yeah, you bet. We touched on it a little bit, but for your excess lines of coverage that you wouldn't typically think about as a captive opportunity, if you've got somebody 300,000 and above for an excess layer, there's a captive solution there that could work and be very attractive. Everybody usually thinks of captives as a casualty tool, PNC, which they definitely are. But there's also a ton of captives being formed and a ton of money to be saved on the medical benefits side. If you have anybody in your audience is operating in that space, we've had a ton of success with self-funding and captives on the benefits side. And then your other hard market items. I mean, your GLs and your auto. There's good captive solutions out there for that. So I think those are the things I'd be thinking about if I was out there, looking at my book of business or future, books of business. That's the thing is, there's a lot of brokers out there not talking about this stuff. And if you aren't, you probably should be, because if you don't, somebody else will. And, your client will be taking meetings with, with other folks. So, so definitely get out there and at least bring it up.
Yeah. And I mean, that's a fair point. So I want to wrap up with this. I think, from what I've processed over the course of the last few minutes of us talking, this is exactly the wheelhouse where we play, specifically in my agency, but also, for those of you who've never understood why I think it makes sense to call on people a month after they renewed. If you still don't know that after listening to this, then you probably are never going to understand that concept, because he already told you 7 months, 8 months lead time. You're already bumping up against the renewal time. So you may as well hit them a month after renewal. And guess what? It's an easy time to create doubt, because all you literally have to ask is, just out of curiosity, how did your renewal go? When your agent came and spoke to you, what was the captive solution they offered, knowing the market's continuously hardening? They're not going to have offered one. Very, very rarely will they. So you can at least pique the interest. And I suspect the reason the question's not asked is because people are afraid to ask it, because they don't feel like they know enough about it. We just spent almost an hour giving you a baseline education and some things you can use as talking points to just open opportunities. All you have to do is ask the question. When they respond, your response is really simple. Well, I think it would make a lot of sense to possibly look at what it would take to do a feasibility study, so that we have plenty of time leading into next year's renewal to see if we have the ability to reduce your total cost of risk by introducing a captive solution. Is that something you would be interested in? And if they say yes, now you've already got the ball rolling with plenty of time to do it. Don't wait till 2 weeks before renewal, because you're going to get skipped over and told to go reach out to them after renewal and start, further out next time. You have plenty of opportunity to do that. So if you look at your own book of business, it should be a normal conversation. But if you're looking at your prospects, go ahead and sort your prospects based on size, and the stuff that's at the top of the heap probably has enough premium that this is a valid discussion for you to be having. All you have to do is introduce the concept. I'm pretty confident that if you do that, Jared and his team know enough about what needs to happen on the back end that they can take it from there. But if you don't ask that question and somebody else does, you're really going to wish you had taken the time to ask the question. We don't gain anything at all in life by allowing ourselves to remain comfortable. Push yourself in your boundaries, ask the questions other people aren't asking, and you'll live like nobody else lives because you'll make more money than they do because you did what you needed to do. Jarid, I thank you today. Jarid's website for riskmanagementadvisors.com is www.riskmgmtadvisors.com. You can find him from there, and we'll also have some contact information in the show notes when this episode's released. Thanks for taking time to jump on the show with me today, my friend. And we look forward to hearing about captives and all of the success the Power Producers listeners have achieved from having you on today.